Welcome to What's Not Priced In, a weekly investor podcast by Fat Tail Investment Research. In a world of confusion and rapid change, experts Kiryll Prakapenka and Canavan look behind the headlines to unveil the hidden opportunities within the Australian stock market. Now, let's dive into today's episode.
In today's episode, Greg and I struggled to find the right analogy to explain the bullish sentiment over in the US. Are investors asleep at the wheel, hurtling towards a hard economic reality? Greg does think tech valuations are overstretched, and his chart of the week illustrates why. Now, turning to Australia, we discussed the much more grounded sentiment of Aussie investors, and that's no surprise. The ASX 200 has gone nowhere in 2 years. We also covered the weakening Aussie dollar and the outlook for key commodities like copper and iron ore as China's economic recovery continues to disappoint. And we finished with our stock of the week. No matter how you package it, the outlook isn't great. Hello, and welcome back to the 7th episode of What's Not Priced In. As always, I'm joined by Greg. Greg, how are you?
G'day, Kiryll. I'm well, thanks, mate. How are you?
Good, thanks. Well, I usually, sometimes I like to sort of stump you at the start of the episode with an interesting quote that I think encapsulates the spirit of the show. And I think I did that maybe 2 weeks ago, and I've got another one for you today. You probably actually might know this one. It was published by Howard Marks in about 2006. It was his Oak Tree Capital memo. And he was sort of talking about his performance. And I'll start the quote now. And he was saying, I quickly recognized that my strong performance resulted in large part from precisely this fact. I was invested in securities practically no one was talking about or knew about or deemed desirable. So if you seek superior investment results, you have to invest in things that others haven't flocked to and caused to be fully valued. In other words, you have to do something different. And then later on, he sort of elaborates. Remember, your goal in investing isn't to earn average returns. You want to do better than average. Thus, your thinking has to be better than that of others, both more powerful and at a higher level. And since other investors may be smart, well-informed, and highly computerized, you must find an edge they don't have. You must think of something they haven't thought of, see things they miss, or bring insight they don't possess. You have to react differently and behave differently. In short, being right may be a necessary condition for investment success, but it won't be sufficient. You have to be more right than others, which by definition means your thinking has to be different. So what do you make of that quote?
Love it. I've heard of that before. I wasn't familiar that it was from way back in 2006, but that's the point, right? Good quotes stand the test of time. And 2006 wasn't that long ago, but we have gone through quite a few different market regimes since that time. And all I would add to that is that what he's talking about there is really having patience and the emotional strength to be able to look for areas that other investors are not interested in. And sometimes they just don't come up. And this week, as this week was unfolding, I was thinking, well, there's not really a standout contrarian trade here at the moment. It's a pretty boring market. And then we had the last couple of days, which was quite good. So we do have something to talk about.
Yeah, and we'll get to it. And I think the reason why I was sort of thinking of that quote is because we don't want to sort of fall into the trap of slavishly paying attention to whatever's trending in the news and constantly thinking along the same lines that everyone else is thinking of. But having said that, we will sort of talk a little bit about interest rates. But I do sort of want to maybe get your contrarian take on interest rates, because I think everyone pays attention to the news. Everyone sees the newspaper. Everyone knows that interest rates are high. Interest rates may rise a little bit higher. But as investors, and as Howard Marks' quote was sort of saying, we have to think a little bit differently, have to look where people aren't really looking. So if we are to talk about interest rates, how can we talk about them in such a way that we are thinking along lines that other people haven't really thought of before?
Yeah, good point.
It's a steep challenge.
It is a steep challenge. And sometimes, the answer is there's not much value to add. You just need to wait until opportunities come that, from a contrarian perspective, seem really obvious. And a couple of weeks ago, we spoke about property trusts being a good contrarian bet against the rising interest rate and the concern over commercial real estate. And the gist is, when all that stuff is in the news and on the front pages and and very much at the top of investors' mind, you can say, okay, well, a lot of that's priced in, and we're seeing good value there. So potentially that's an opportunity to build a position, take a position. Not that you're going to see a turnaround straight away, but I'd imagine these are the types of positions that Howard Marks was talking about when he was saying to think a little bit differently from the pack. So this week we've got an interest rate decision from the RBA, and we were watching that on the Tuesday. The market was actually selling off into that decision, not in a drastic way, but it was obviously there was some concern about the fact that rates would rise. And then when the RBA didn't raise rates, the market shot really higher, and it looked like, just from the reaction of the market, that the RBA had actually cut rates. It was a silly reaction, but it was more, I think, a reaction that a lot of traders were caught on the wrong side of that decision and had to cover in order to get back to neutral in terms of their positioning. So, and then obviously the next couple of days we've seen selling kick in, and we're recording this at about 10 o'clock on Friday morning. We're a bit after the market open, and I just looked before the market's down 1% today on the back of a 1.2% fall yesterday. And overnight in the US, you saw market interest rates kick up considerably. And there's obviously that concern about higher for longer. And I think that's been one of the themes that we've been discussing on this podcast is, when we've said what's not priced in, it's the fact that the Fed and central banks around the world are saying, we're going to raise rates and we're going to keep them higher for longer than you currently expect. I would suggest that is still not priced in. So unless you want to talk about interest rates a little bit more, I think we can maybe start to look at some evidence of where that not pricing in is still happening.
Yeah. Well, actually, I think before we go, I think maybe some people may be wondering, what is the actual significance of the fact that the market is not pricing in high for longer interest rates? Why does it matter?
Well, I think it matters because there's a lot of downside risk. So you're either going to get interest rates or the Fed starting to cut quite quickly to close that gap. And when I say gap, I've got some charts to show you that clearly demonstrates there's a gap between where the market has gone over the past, say, 3 to 6 months and where interest rates have gone. So look, we're talking about markets, and the other side of that coin is that there's lots of stocks out there that are good value. But if we're talking just about broader markets, then I think the market is quite exposed, and especially in Australia, and we'll get to this later as well, is that we're very exposed to what's happening in China at the moment. And it's well known that commodity prices have been under the pump for the better part of, let's say, the past 12 months. We've gone through a post-COVID correction as a lot of that money supply comes out of the global economy. China reopening was a bit of a fizzer. The expectation that China would then stimulate to create more growth when the reopening theme didn't sort of play out, that's been disappointed as well. And Australia is reflecting that lack of impetus from China, and it's reflecting the fact that interest rates here are really putting pressure on households in terms of the mortgage rates. And a couple of weeks ago we showed that chart. We're just in this quarter, and we've moved into the September quarter now. You've got $60 billion worth of term funding facility that's getting repaid to the RBA this quarter. So effectively, that's $60 billion worth of low fixed rate interest that are going to reset to a higher rate just in this quarter. So to me, there's still a lot of pressure that's going to be put on the consumer, the retailers. Yes, their earnings expectations have been wound back quite a lot, but I think in the short term, there's still going to be considerable pressure, because at the end of the day, the rapid rate rise that the RBA has done over the past 12 months still has a long way to go in terms of the lagged effects of those rises. So we're still going to feel the pain for that for some time.
Yeah, and just maybe moving on maybe to, you've said that it looks likely that interest rates are going to be higher for longer, but the indicators, I think, especially in the US, are still, the sentiment indicator is still very bullish. And I think we have a contrarian magazine cover as well that's sort of saying, "Oh, is this like a strong bull market?" But I think you are sort of saying that the US is slowly starting to wake up to the possibility that things aren't going to be as smooth as they think. So maybe just a comment on that from you.
I don't know about whether they're starting to wake up. Perhaps they're starting to sort of stir a little bit.
Yep.
But I just want to show a couple of these sentiment indicators to give you an idea that really the market's still sound asleep to this higher for longer theme. So CNN Greed and Fear Index, this is one that we've showed constantly over the past few weeks, and it's still firmly in the extreme greed range. Now, if you're interested in this, you can just Google CNN Fear and Greed Index, and there's about 7 sub-indices. And I think about 6 of them, maybe 5 or 6 of them are in the extreme greed range. So from internal sentiment, all those things that go to feed into this, there's no sign of concern at all. And if you look at the investors' intelligence, this is the bulls and the bears ratio, that has just rocketed out of a really bearish range that was in 2022 and hit just on 3, which essentially means for every bear there's three bulls out there. Now that you can see here, like that doesn't necessarily mean we are stretched. Like in genuine bull markets, that can stay at a high level for some time. And I guess that's the biggest question that a lot of people are still grappling with is, are we in a bear market rally or are we in a new bull market? Now, I would suggest with interest rates rising, with the, I guess, tail end of the COVID stimulus in the US especially, just starting to wash through the economy. My view is that you're not in a new bull market, and whether the bear market gets a lot worse or not is another question. But I certainly don't see a lot of rationale for ongoing share price rises. And the fact that the sentiment has rebounded so quickly, and this is really in the last couple of months. And I think on our first episode, we covered the NVIDIA and the AI boom, and this has really gone from there, and everyone's sort of got bulled up and willing to bet that this is a new bull market. So from a contrarian perspective, this is a little bit of a concern. And then you dug this out during the week. This is a Barron's headline. I think you said it was from June.
Yeah, last month. Yep.
So, speaks for itself, really. This market has legs. The bull is back, and why more stocks could join the tech leaders. Sure, in the short term, that's clearly played out. The market breadth has broadened over the past month or so as people have probably thought, okay, well, the big stocks have had their run. I'm going to try and find something else to jump on board, which is, how a lot of these markets work. But to me, we look at these magazine indicators as a contrarian indicator because this is what editors and publishers feel comfortable publishing because they think that's what their readers want to read, or that's the dominant narrative in the market. So that was a good find, mate. That's just another confirmation that this bullish sentiment is potentially overdone. And then if we have a look at some of the big tech stocks, and this is interesting because when I look at them from, let's see, a perspective of, where were we? So let's go to Apple, and I'm going to show you Apple on a weekly timescale. And let's just have a look at the RSI, which is it's called Relative Strength Index, and it's effectively a momentum indicator. And over the past couple of years, obviously Apple's been in a very strong bull market, which is indicated by these really overbought. So whenever the RSI is above 70, it's considered to be overbought and stretched from a short-term perspective. Now, in recent years, I just marked when the RSI was, I think this is above, when the RSI got above 80. So here it got above 80. This is on a weekly indicator. And over the next couple of months, it fell nearly 35%. So the next time it got above 80 on the weekly RSI, it went on to fall 25.5%. And this is just recently. So that was last Friday. It hit 86 RSI, which is obviously very, very stretched in terms of the momentum on it. So I just marked a 30% being the average of these two. So it's completely unscientific. It's just giving you a rough guide of where potentially, if Apple was to follow these last two instances of when weekly RSI was above 80, you're going to see Apple back down at these lows that it made during the bear market of 2022. Now, moving on to Microsoft, that hasn't done quite as well as Apple, but we are, and I'm just going to get rid of this RSI and just go back to the daily indicator here. So it is bumping up against these former highs. So to me, that's a warning sign as well. The FANG index back up at these highs. Now, I'm pretty sure that's probably just breached those highs. Now, often, if you listen to our technical guru Murray Dawes, he's often talking about false breaks of highs. Now, a lot of the time, what happens is that investors get excited and say, "Oh, it's broken out to a new all-time high. I'm going to jump on that." And what happens is that not enough momentum is there, and it quickly rolls over and falls back down. And Murray calls those false breaks of highs, which can be quite a bearish signal from a technical perspective. So the FANGs have just got up there, just broken those highs, and if sentiment is already at an extreme reading, if sentiment indicators are high, if the extreme greed sentiment indicator has been on that level for the past month, and that's been maintained at that level. It doesn't often happen for that long. You question how many more buyers are there to keep pushing this higher. Tesla's another one that's just had a big rally, big sell-off, big rally. Everyone's jumping back on the Tesla and the EV train. Similar thing with Meta Platforms, Facebook, big rally from its big sell-off. So yeah, they're the tech indicators that to me just suggest, along with sentiment, they're just ignoring the fact that interest rates are continuing to go higher. And just to show you that, last week we spoke about real interest rates. So if anyone missed that episode, essentially we were talking about the real interest rate and the correlation of real interest rates with gold specifically, but it is correlated with other assets as well. And overnight, we saw a big jump in nominal yields. And so when nominal yields jump, real interest rates rise as well. And that's pushed the price of these tips lower. So it looks like they're going down to test these lows of October last year. Now, the interesting thing here is I matched up, or I correlated the price of tips with the NASDAQ and the S&P 500. And this is what I was saying before with that gap, Kiryll, is that we've been talking about that stocks are ignoring or not pricing in the higher for longer interest rate narrative. And that is nowhere more obvious than in the performance of these tips, which is the price of real bond yields. And for those who might not be familiar, when yields rise, prices fall in the world of bonds. So the fact that tips prices are falling is telling you that real yields are rising, and they're rising back to a level that we haven't seen since September, October last year. Now, last year during the bear market, sorry, mate, what was that?
I just said that's a great chart.
Yeah. I mean, look, last year in the bear market, yields, tips and the S&P 500 and the NASDAQ were all highly correlated. And yes, they were a little bit correlated during this rebound from there, as the market thought, okay, well, we're going to see lower interest rates. But this higher for longer and the determination of the Fed to keep rates higher and keep raising rates is seeing tips fall back down. But the stock market is just on a tear because of these sentiment indicators, and people seem oblivious to the underlying tightness of the financial system and the effect on the economy, and they're just going off to the races. Yet the tips are telling you that monetary policy is going to remain tight. So for me, this is not priced in at all, and there is a definite downside risk to the markets in the short term. Now, we did discuss gold last week, so it's worth pointing out that gold has trended down a little bit with the tips, but obviously with the recent action in nominal bond yields in the US and the fact that inflation expectations continue to trend down is not providing any support to these tips prices at all. So they've gone down. So this poses a risk to gold prices as well. So if gold was to catch down to this, you'd be looking at gold back down around $1,700. Now, the fact that it's not, you could interpret that as bullish. You could say, well, gold's looking through this period of monetary tightness and looking at interest rate rises. But as we said yesterday, I would just caution, as much as a gold bull that I am, I'd just caution that that is a little bit of a concern. So it's a concern for all asset prices, right? When real yields are as high as they are, that puts pressure on asset prices everywhere.
Yeah, and I just had a random question. This is clearly maybe before my time, but is there any parallels right now with the people's obsession with the top 10 stocks in the US with the Nifty 50 stocks way back when people were saying you just buy them at any price and they'll just keep going up?
Suggesting that I was around in the 60s and 70s.
Not necessarily, but maybe your points of comparison, where...
Well, that's the whole point about stock markets. It's the same story, just in a different guise. So, I mean, just to confirm, I wasn't around at that time, but from what I've read, the Nifty 50 was a pretty heady time. But I would also say that back then, PEs were off the charts. And I remember that our very first episode, we looked at some of these tech stocks, and they are genuinely global monopolies. So back in the Nifty 50 days, the world hadn't globalized like it has now. And I think the prospect of becoming a global monopoly was getting priced into those stocks. Whereas if you look at your Googles and your Facebooks and your Amazons, they're already global monopolies. I mean, Apple is a global monopoly, and they're generating significant cash flows. They've got no need for debt. They got very high return on equity. So in many cases, they're high prices and they're big margins. I was listening to a podcast with the legendary Joel Greenblatt, investor from Gotham Capital, and he was making the point that these companies, they're more capital light than companies of old. So if you're comparing back to even in the 90s and the 80s and the profit margins of companies, it used to be that the industrial conglomerates were the big companies back then, whereas these tech conglomerates or these tech monopolies, they're very capital light. They generate so much free cash flow that what looks to be an incredibly overvalued market isn't necessarily as overvalued as you might think. Now, I'm not saying that these stocks are fair value. I wouldn't be buying them at these levels. I think those stocks have probably got a decent correction in them if sentiment does change. But I'm certainly not suggesting that they're going to, fall 50, 60, 70% like a lot of the bears are suggesting, purely to get back to historical margins and things like that, because these companies are just different. But I didn't say this time is different. I said these companies are different.
Okay, that's a key difference there.
Yeah, well, some would say not a difference at all. It's just put in a different way. But look, I'm not a cheerleader for these stocks. I'm just trying to point out that they are different in terms of profitability, cash flow generation, and lack of they're just capital light. They're not very capital intensive.
Yeah, and I think that free cash flow sort of feeds on itself, because then they can spend a lot more money on research and development, and then just constantly expand their sphere of influence and all of the new products, and then that way.
Not to mention buybacks, Kiryll. They've got billions to buy back their shares. So whenever there is share price weakness, they can just institute a share buyback scheme, which reduces their shares on issue, which increases all their earnings per share multiples. So they're in a pretty good position. Once you're a global monopoly, like the barriers to entry to compete against that they're almost impossible. So they are very, very dominant businesses.
Yeah. And I think just on the tech stocks, I think it's a nice little stat there that I got from Financial Times. I think the top 10 S&P 500 companies accounted for about 13% of the broader index's 16.9% first half gain of 2023. So in other words, without their gains, the US market would be up about 4% year to date. So maybe some people are saying that the rally is broadening, but it's not really broadening that much. It's still relying in a big way on those handful of stocks that you can literally count on two hands.
Absolutely. And if you think about it, what do people do when they want to get in the market? They go, all right, I'll put it into a NASDAQ ETF because the NASDAQ's going up. So you put it into an ETF, or if you put it into a FANG index, that just takes all the money. So I would argue that there's not a lot of individual stock selection going on. There's a lot of ETF buying going on that are centered on these types of sectors or industries, and that's where all the money's going.
Yeah, and I think there was another chart. I didn't send it to you, but although the Nasdaq has been doing really well, if you really look beneath the surface, a huge chunk of it is still deeply underwater. So I think about there's probably about 30% of the Nasdaq is still down more than 75% from its 2-year highs. So when you really look into beneath the surface, there's still a lot of stocks that are struggling, and it's just all being propped up by the Zuckerbergs and the Musks and Bezos isn't really part of Amazon anymore. But
absolutely, I'd agree. And if you look at some of the data out of the US, I think this week we had the ISM indices, and the manufacturing sector is in contraction. The number came out for June. The manufacturing ISM was 46.3, and anything below 50 is an indicator of contraction, and that was down from 48 the month before. On the services side, the services industry is still going quite nicely. That the reading came in at 54.4, which was just down slightly from 54.9 the month before. And to me, that tells the story. I think we mentioned it earlier, is that there's still this residual spending from the CARES Act, which was a COVID era stimulus policy that's still working its way through the economy. But I'm not 100% sure, but I don't think there's any more major spending to come from the government on that front in terms of stimulus checks. So that's why you're sort of seeing this lagged impact from the services sector that's still quite strong. And I guess the flip side of that, or not really the flip side, but the other question that comes from that is this why the employment market is so strong, or are there other demographic factors that are weighing on the jobs market? So, are the baby boomers starting to move out of the market, move into retirement, and therefore take a big chunk of potential labor out? And is that why we're seeing this labor wage pressure? And to me, that's the biggest thing that the Fed's going to be looking at. It's just employment and wages. And until that starts to roll over, in which case when it does, it'll be too late because it's a lagging indicator, but the Fed will want to see that weaken before there's any sign of them taking their foot off the brake to slow things down. So it's almost like the Fed is going to stay tighter for longer until there's an obvious slowdown, in which case it's too late for them to start cutting because the slowdown will already be there.
Yeah. So it'll probably cut when it'll conspicuously break something big, in which case it's not even going to be that great for markets anyway. So, and I think just on the job market, I think just today new data came out. I think the US gained about 500,000 private sector jobs last month, and that was double economists' expectations, and that was probably the biggest rise in more than a year. So the labor market is still strong. I think the US Fed is not going to be that happy. And it just as an aside, the economists continue to sort of miss these forecasts. I think they constantly undershoot their forecasts. So it's interesting.
But it's a real head scratcher from my perspective as well. Like there's clear signs of a slowdown going on, yet these employment numbers are just relentlessly strong. So I'm not sure what's going on there. And that was the reason why you saw bond yields overnight tick up, and the 10-year US bond yield is back to back over 4%. Now, if you're looking at a investment opportunity here, I would say bonds are getting to a point where they'd be good buys, because the Fed is going to tighten until things slow down, and that is going to see bond yields fall again, which means prices will rise. So the peak for 10-year bond yields came in October 2022 at 4.22%, and we are now just a bit over 4%. So in the next week or so, you could see that that level tested again. But my view is that it will hold, and that will probably be another good buying opportunity for bonds. I've been recommending bonds for a little while, just as an additional sort of defensive part. It hasn't worked out as an investment. We're sort of down a little bit on that, but from a longer term perspective, I think bonds are a good area just to allocate some defensive capital, purely because the Fed and this higher for longer theme, and the fact that the market in general is ignoring it, suggests that that's where the value is. Bonds are back at their level from October 2022, and stocks are back up here. So if you want to try to look at where the value is, in my view, it's the bond market.
Great. Well, watch this space. We'll keep tracking that. But I think now we'll maybe turn to Australia and the outlook for Australia before we turn to our stock of the week. I think there was more data from China that sort of suggests that its economy is weak, and that's going to have knock-on effects, obviously, for commodities. And Australia does rely heavily on commodity exports, so I think the Aussie dollar is sort of also remaining weak. So, what do you make for all of that? And
so
for Australia,
we just mentioned the US manufacturing and services data for China that came out during the week as well. So the services number was 53.9, which is obviously still showing signs of expansion, but that was down from 57.1 in May, so it is slowing. And the manufacturing data just keeping its head above water at 50.5, down from 50.9. The other interesting thing is that China is not going through any of the inflationary concerns that the Western economies are going through, and that is more of a reflection that they didn't lavish money on households during the COVID lockdowns. So, if anyone's confused about why inflation just blew up in 2022, it was a lagged effect of the government saying, everyone stay home and don't produce, and we'll give you a ton of money so you can consume. So if you shut down production, i.e. supply, and you increase demand, price rises are going to happen. Like, it's just economics 101. China didn't do that, so they're not grappling with this inflationary concern. They're actually more worried about this disinflation and deflation kicking back in, because they're trying to manage their property bust. Youth unemployment in China is around 20%. And the reopening of China after its COVID restrictions didn't really produce the bounce that everyone was expecting. And I think that's the biggest thing weighing on the Aussie economy right now. There's a couple of charts just on that front that are worth pointing out. So a couple of weeks ago, we showed the Chinese currency, the yuan, relative to the US dollar. So this is the yuan US dollar index here. It's been falling for some time. So if I just zoom back out. So 2023 started here. You can see, and sorry, this is obviously the copper price and the iron ore price that correlates quite well to the yuan. They started rallying in expectation of a reopening. Now, when China did reopen and it was a bit of a fizzer, everything rolled over. Here, we've seen a separation of copper and iron ore prices while the yuan has continued to fall. My guess is this was around the time that China announced a few stimulus measures, but the stimulus was very lackluster. It's not going to do anything major. So, whereas the commodities responded to that and said, okay, well, this is going to boost demand for these commodities. But if you look at the correlations here, it hasn't really worked out for the Chinese yuan, and there's the indication there that things are still quite weak. So what's not priced in here is this potential catch up of copper and iron ore prices that might come back down to trade around where the Chinese yuan is, which is, to me, that's a downside risk. Now, if we go over and look at a couple of charts, this is the Aussie dollar, and the Aussie dollar is really, in my view, I've looked at it a long time, it's just a global barometer for economic growth, that sort of stuff. Now, the Aussie dollar bottomed around the same time as global stock markets, and that was obviously when concern was around that the global economy was slowing quite sharply. This was around the time of the energy crisis in Europe as well. Then we had a big bounce again on the expectation and hope that the Chinese economy would reopen and reignite global growth. That didn't happen, so we've rolled over. Here, this bounce related to hopes of China stimulus, and also the fact this happened around the same time that the RBA raised rates as well. But we've seen it roll back over again. So from a long-term perspective, the Aussie dollar is just trending lower and lower and lower. Yep. And while this is a different conversation and one we can maybe explore in future weeks, if you think about the high level of Aussie house prices, the huge cost to service debt, the fact that house prices are well beyond the average house price is well beyond the range of the average wage in Australia. There has to be a valve that takes the pressure off somewhere, and generally those valves are in currency. So I wouldn't be surprised in the coming year to see the Aussie dollar break down to new lows and even get into the 50s. But as I said, that's probably a conversation for another time. And just looking at this is the ASX 200 resources index. So this is clearly driven by your BHPs and Rios and Fortescue, so obviously the big iron ore miners. It is forming this consolidation range here, and by the look of things, just the way the market's going, wouldn't be surprised to see that breakdown out of this range, and you're going to see lower prices in the months ahead. Having said that, I wouldn't be expecting a bloodbath in the sector. That those stocks are very well capitalized in terms of their balance sheets, generate significant free cash flows. They've got world-class assets. So it all really depends on where the iron ore price goes. I think iron ore prices are probably going to head down to the $80 a ton level, US or lower. But on the flip side, if the Aussie dollar keeps falling, then that provides a little bit of offset for the big miners. And just one other chart I wanted to show you, just to give you a sense of the state of consumption in Australia, which the trade figures came out yesterday, and I dug into them just to have a bit of a squiz on the imports and what was coming in. And you can see the consumption goods here, and overall it looks really strong. From month to month, it's up 7.7%. You got food and beverages for consumption down 4.3%. You got household electrical items down 3.4%. Textiles, clothing and footwear down 1.6%. And toys, books and leisure goods down 4.1%. The main thing propping that figure up was it says non-industrial transport equipment, but it's essentially cars coming into the country. And as you know, there was a huge backlog of orders for cars from the COVID supply chain crunch, and you're seeing a lot of those start to come in now as the semiconductor industry resupplies the car manufacturers, and all those things are freeing up that supply chain. So if you take that out of the equation, consumption is actually quite weak, which reinforces the view that we've talked about over the past couple of episodes, that rising interest rates, fixed rate mortgages resetting to higher are really hurting consumption in the household sector. So doesn't paint a pretty picture for the Aussie consumer and the Aussie economy, and especially if the RBA is going to continue to keep rates high, and the market's pricing in another 1 to 2 interest rate rises by, I think it's September. But whether the RBA raises again, my view is that it's probably a lot lower odds than what the market's pricing in at the moment.
Yeah, and even if they don't raise, they will probably hold them high for a long time to come, and that'll just, either way, the consumer is going to feel the pain, whether another 50 basis points are raised or not. They're in a dire situation.
Yeah, there's not going to be rate cuts for a while, and if there are rate cuts sooner rather than later, it's not going to be for good reason.
Yeah, and I think that's a point that's sort of overlooked. I think people sort of sometimes, it's easy to sort of think, oh, well, if the rates come down, that's great news. But you also have to remember, well, what's the reason for the Reserve Bank to sort of start drastically cutting rates? They're not going to do that if things are going well. They're going to do that if things are going quite badly.
Exactly. And we've talked about that before. We've shown how in rate cutting cycles that the market continues to decline because it's still reacting to the lagged impact of the former tightening cycle. And these things do take time. There's not an immediate reflection in the economy or on company earnings. And once sentiment changes on that front, it does take time to change. Right now, sentiment's as strong as it has been in some time, and the US market is blissfully unaware of the tightness that real interest rates are imposing on the economy.
Yeah, so it's not waking up yet. It's not even stirring. It's like still a sleeping
Sound asleep,
beauty.
Mate.
snoring its way through to disaster.
Yep.
Well, okay. I think with that, we'll turn to the stock of the weekend. It's probably not great news as well. It's the giant packaging company Amcor. So yeah, take it away.
Yeah, I thought we'd just continue on the same theme, really. So Amcor is a stock that just came across my screen yesterday. It's not a stock that I follow closely. It's a global company. It's a global packaging company, really. So it's a good indicator of the movement of goods throughout the economy. So pharmaceuticals, food, beverage, all those sorts of things. It packages them up, and obviously other companies move them around. But the demand for its product is a good indicator of just underlying movement of goods in the economy. So it peaked in August last year, and since then it's down around 22%. And I'm not sure what it's done today, but there's a good chance it's going to break below the lows that it reached in March of 2022. And that was on the back of, obviously, supply chain concerns around the Ukraine-Russia war. So to break below that level would be reasonably significant. And it's just another indicator that real underlying economic growth is not as robust as the US share market is probably leading many people to believe. But having said that, the Aussie market, to me, is much more rationally valued. So as much as we might point out the fact that the US market's asleep and sentiment's off the charts, I think there's a different story unfolding in Australia. And as much as I'm concerned about some short-term sell-offs, I'd be looking at these sell-offs to be adding selectively to portfolios, because I do think there is good long-term value around.
Yeah, well, the SX 200 definitely doesn't. It lacks the distortionary field of something like an Apple, or I mean, Apple is probably bigger than the whole of the SX 200, so it doesn't have that.
The SX 200's gone nowhere for 2 years. So to me, when a market goes sideways for 2 years, there's a lot of average news priced into that market. It's not excited. It's not depressed. It's not. So from an overall market perspective, it's hard to really see a contrarian take where you can get excited about being bullish or bearish. But in individual stocks, I think there's plenty on offer. And there's plenty of good stocks that have fallen 50% from their highs and are looking relatively attractive. And as we talk about, the question is really, have future earnings estimates priced in a relatively conservative future forecast that you can buy into? That's the real question. It's looking at earnings and saying, okay, is that a fair reflection of what I can expect in the next 12 to 18 months?
Yeah, great. And I think maybe next week we'll potentially look at dividend stocks, so people can maybe stay tuned for that. But with that said, I think we've covered everything. It was a nice and speedy and a nice discussion. So
we have covered everything.
Anything else to add? Any
Well,
final thoughts?
I would just say on that, in future weeks, we're also looking at bringing in some third-party interviewees to add to it and get other people's takes on what's not priced in. So in the coming weeks, we'll be introducing some guests, mate. I don't know if I've told you about that, but that's the plan.
Viewers, he did not tell me this, but that's how it wasn't priced in on my end.
No, keeping in theme with the podcast, mate.
Exactly. Well, thanks, Greg, and see you next week.
Thanks, Kiryll. Thanks for watching.
See ya.
Bye.
Thanks for joining What's Not Priced In, your weekly source of unique ideas in the Australian stock market. Now, if you've enjoyed this episode, please show your support by liking and subscribing and turn those post notifications so you don't miss a thing. And stay tuned for the upcoming episodes as we delve into new topics, new trends, and new stocks. Thanks for your support. Hope to see you next week.